All right, we're going to take a look at a trade that is expiring today. Today is Friday, February 2nd, 2024. And I just want to quickly go over this trade and show you a couple of things. I got some questions about a trade that is initiated. This is a 112 bear trap, and sometimes the way I trade these 11X bear traps is that I take a smaller credit up front and I may increase the size of the bear trap. This also may allow me to push my naked short options farther out of the money. And I want to point out that the reason why this trade was set up the way it was, and you can see that this was a 10 lot, and I had a 50-point wide put debit spread, but it was closer to where the underlying index was trading at the time. My delta was slightly higher. As you can see, when I initiated this trade, delta on the long leg of the put debit spread was at 38. So I spent more on the put debit spread, which means that I take in less of a credit, right? So for example, if I sold the 42.75 puts naked and I bought the put debit spread farther out of the money, I would have spent less on the put debit spread, which means that the proceeds from the short naked puts would not just cover the put debit spread, but it would leave more of a initial credit or tail profit, if you will. So here I decided to put my put debit spread closer to at the money, which means that I'm paying more for this put debit spread, which also means that I'm taking less credit up front, which equates to a smaller tail profit. So now we can look at a chart, and the reason why I did so is because what I felt like were stretched to the upside. You can look at RSI was way over 70. We were 79 on the RSI. MACDs was bullish, but I felt like we were just a little bit too far away from the underlying moving averages, which are 8 and 21 in this case. We're way above 8, 21, and 50-day moving averages. So doesn't mean that the market can't go higher. I just thought that I didn't want to initiate this position with a ton of long delta to start with. So this was a 10 lot, and it gave me about plus 23 SPX delta. There was not much done to this trade. This trade was put on December 14th, 2023. And as we know, with 112s, there are three potential outcomes. If we finish above the long leg of the put debit spread, we just get to keep our upfront credit. If we are inside of the put debit spread but above the short naked puts, we will make the bear trap profit. This is the bonus, right? We'll make 50 points or $5,000 per one contract on the put debit spread, plus the small credit that I collected up front. I only collected about $2.50 for this bear trap, whereas in a normal or a typical 112 that I do, I would collect somewhere close to about $10 credit. Here I collected $2.50, so only about 1/4 of what I would normally collect. And we can go forward and look at what this trade looked like when I made the following adjustment. There was only one adjustment made, and the point of this video is I wanted to show you how I sometimes take a lower credit up front, but that doesn't mean that I'm just going to leave it alone and do nothing about it. I look for ways to milk these trades or pull a little bit more out of these trades in the event that the market does not cooperate and go inside the trap like I thought it would. So we can see this is what this position looked like before I made any changes. So I'm in this trade for 22 days. The underlying actually has gone down about 0.3 standard deviations, and volatility went up a little bit. we can look at the price chart, and this is when I took the trade. We kind of went up a little bit, came down, tested 8-day, came back up, made a slightly higher high, came down. Now we're testing the still rising to flattening 21 EMA, and there are still 28 days on the clock. So we are about halfway in, and as you can see that we're still above the long put debit spread, but the value of this put debit spread is either increasing or my naked puts are decaying much faster than my put debit spread is decaying. I think in this case, this was a combination of both. The value of my put debit spread is actually increasing while the value of my naked puts decreasing. So we have two components both working in our favor, and this is the result. We're seeing a P&L higher, right, than what we would expect to see. And we can see that at expiration, right, all we can make here is $2,500. This is what I collected up front. But because the value of the put debit spread is rising and we still have 28 days to go, we're actually seeing a net P&L much higher than what the P&L is for this trade if we were at 4,700 on the day this trade is expiring. So with that being said, what I decided to do is I decided to increase my potential reward if we were to just come down here, test the 21, and continue higher. What I did was I rolled I'm just looking back on my notes, and this is what I post on Discord for every trade that I take. So I wrote, and I'm going to do a screenshot and show you what my notes were. Here we go. So this was on January 5th. We had 28 days to go. We were in this trade for 22 days. And I wrote a note to all of our members. I'm going to roll the long leg of my put debit spread down 25 points, collect the credit. And I'm going to close half of my short naked puts. I'm going to pay a debit there. This was a net credit transaction, which means, right, I'm going to collect a net credit for this adjustment, about $4.50. And this will accomplish the following. One, it's going to increase tail profit potential. It's going to increase the tail profit by the amount of credit that I'm collecting for this transaction. It's going to decrease trap profit potential, right? Because I'm shrinking the size of my put debit spread from 50 points down to 25 points. And by closing half of my naked puts, it's going to free up some buying power to continue to add other positions. And this is what, right, the adjustment was to roll the 46.75. So if I sell to close 10 and I roll them down 25 points, and then I go out and I close out half of my short naked puts, you can see that my tail profit has gone up by, and this trade is going for, oh, now it says here 430, but the trade was filled for $4.50 credit. So I go from 2,500 or 250 plus 450, right, which is 7. So now I go from $2.50 potential reward in the tail to $7, or on the 10 lot, that's $7,000. Now that's great, right? There's always the positive and the negative. That's the positive. I increase my potential reward outside of the trap. What's the negative? The negative is if we do go lower and we end up somewhere underneath 46.25, instead of making $5,000 per one put debit spread, I'm now going to make $2,500 per one. So I'm cutting my potential reward inside the trap by about 50%. And that's the negative. And then also closing half of my naked puts, this free up some buying power so I could continue to add new positions and continue to keep the wheels moving. So I'm going to go and show you so this is what this trade looked like after I made the adjustment. And there were no other adjustments made. And this is where we are today. This trade is going to expire at 4 o'clock. And as we can see, right, since the beginning of this trade, and on this chart, this is where we were when I made the adjustment. And, looking back, obviously, it makes it a lot easier. But the idea when I made the adjustment, right, I thought, what if we're just pulling back to the 21 EMA and we're going to continue higher? Well, we did continue higher, came back to test this rising moving average again, and we continued higher. So it kind of worked out the way I thought it would, or at least it worked out it worked in the favor of my what if scenario. And now this trade is going to expire today, which means that remaining put debit spread is going to expire worthless. My naked puts are going to expire worthless, and all I'm going to keep is the credit that I collected up front. Remember, initially I collected $2.50. Then I collected another $4.50. That gave me a total credit of $7 on a 10 lot. This is about a $7,000 gain. If I had not made this adjustment here and just left the trade the way it was, I would still end up with a net profitable trade. I just wouldn't have collected the $4.50 when I made the adjustment. I would end up with a trade that showed a gain of $2,500 instead of $7,000. So I hope that kind of gives you an idea about how I go about managing these trades. If you have any questions, feel free to comment, let me know, and I will talk to you in the next video.